Well, let's get some analysis now on the major local and global issues dominating markets. We're joined by George Lucas from Instreet. George, thanks so much for coming in. Now, firstly, if we could ask you the impact of the Qantas dispute and that stunning decision to ground the entire domestic and international fleet. There has been a suggestion that this will have a minimal impact on the economy now that there has been somewhat of a resolution. What do you think?
I actually agree with that. I mean, because it's been resolved so quickly, really over the weekend, and before business travel really started, so it'll affect a bit today, but it'll be solved. I think the impact on the economy will be minor. I mean, we might see a small impact on the Aussie dollar today, as because the news obviously was on all the major newscasts globally, so it was front page of a lot of global newspapers and also on CNNs, etc. And so, there'll be a minimal, maybe a knee-jerk reaction initially, and maybe in the Aussie dollar, but after that, I think the impact on the economy will be minimal.
So I guess the damage to brand Australia, I guess, as well, not just brand Qantas, because of, crying passengers stranded somewhere overseas, their dream holiday ruined.
And I think in a time that we're trying to attract tourism into Australia and we have a high Aussie dollar, so it's actually harder to get tourists to come in, damaging brand Australia is actually quite a big issue going forward. But I don't think the impact will be that major.
Okay. All right, well, let's turn to other issues dominating markets. Of course, the European deal reached last week to try and solve the Eurozone debt crisis there. What, firstly, do you think about it? I mean, do you think it will solve the problems?
Oh, it'll solve the initial problems about the, the bank contagion and getting the euro back or whatever, but I think if people dig into it, there's a couple of things which kind of concern me. One, they didn't capitalise the banks first and then announce the cut on the Greek debt. And in reality, for the last month, it's been a banking issue in Europe and about banks not getting liquidity. And so what they're going to do, they've just set what their capital requirements are. They haven't actually outlined how they could get to them. So not only can they raise capital, but they could cut back on lending, or they can sell assets to get to their capital requirements. And obviously, if they cut back on lending or sell assets, it's actually not going to be very stimulant to the economies in Europe. So it's not necessarily obviously there's a lot more detail to come out about how the banks are going to get to this 9% capital adequacy ratio, but we just have to wait and see. And it was quite interesting that it wasn't just recapitalise the banks, which has been the main issue for the last month, and then announce the haircuts. But in the end, this is all kind of a bit of window dressing. The main issues in Europe about a two-speed Europe, where you have Germany and the German-orientated countries powering ahead, and you have the southern European countries being less competitive, and it will take a while for them to take their medicine and become competitive. People kind of forget that Germany started taking its medicine in the 1990s when it did the reunification to make itself a lot more competitive, and it took them 15 years before they really got back to a level. And that's what we're looking for the southern European countries too. It's a long process.
We did see the euro as well see quite a lot of strength following the announcement last week. What do you think that impact could have on say, Germany?
Well, Germany's actually competitive at a 150 euro. When it was at a 130, Germany's very competitive. And because all the other countries, especially the US, are trying to export their way out of their troubles as well, when the euro begins to fall like it did during October, they actually would like the dollar to weaken. So I think at around 142 is actually the right level for the US dollar. I think we discount how weak the US is, and the US is a lot weaker than we actually make out. Over the next week or so, everything's going to really switch to the US. It's not just the Fed meetings that are coming up this week. There's a two-day Fed meeting, all the unemployment figures at the end of the week. But it's also this super committee on the cuts in the budget, and that's really the big one. It's a bipartisan committee. It's equal numbers from both sides of politics, and based on his performance and current realities in the US, it's not going to be a smooth process, and the markets aren't going to like it. Markets, probably discounting in about $1 trillion worth of cuts. We're really going to need $3 trillion worth of cuts to see the markets really boom. And I think that's going to be a bit of a drag on the markets going through November, what the super committee, especially as we get closer and closer to the date, which is the 23rd of November for the announcement.
Just also wanted to have a look too at the unemployment rate there. Is that something that you will be watching closely?
The unemployment rate is the key in the US at the moment, and it will be what the Fed will be watching, and it's beginning to tick back up. And that's why we're beginning to see a lot more talk coming out of the US about QE3. I think QE3 is a lot harder to implement now because it doesn't really affect employment. It seems to hit the commodity markets and create commodity inflation, and it hits the emerging markets and creates issues for them. So it's a bit hard for the Fed to do, but they will be looking at everything to try and get this unemployment rate down. It is a very key thing in the US.
Now, just quickly to Australia as well, we have the RBA decision on tomorrow. What do you think? I mean, are we going to see the rate cut?
Well, I've been hoping for a rate cut for the last 9 months. I would expect that there should be a rate cut coming up, just based on the softer unemployment figures here in Australia and the softer inflation expectations. But the RBA actually is looking 18 months ahead, and we are beginning to see some of the things that the RBA has predicted, like the pickup in the capex expenditure in resource sector, and we're not seeing the tightening in the labour market, but we are seeing this pickup in capex expenditure, and an improvement in the global economy. So, it's still a line ball call whether they cut, I think.
What about equity markets? There's been a big rally in October. Do you think this can continue?
I think the US market can continue, but it's not going to continue like it did in October, because as we get closer and closer to the 23rd of November, that's going to put a handbrake on the US market rally. So maybe there's another 3% market this month. And the Australian market is at the moment going to take its lead from the US, whether we like it or not. So maybe another 3% in Australia as well. The biggest risk for the Australian market is that the Aussie dollar continues to be strong, and that'll put a handbrake on the Australian market.
All right, George, thank you so much, as always, for your analysis.
Not a problem.
George Lucas there from Instreet. Well, let's return